Hello, Business 202. This Hangout will cover some of the most important topics of Chapter 15 on investments and fair value. This is a pre-recorded Hangout, and we'll review these three items. Number one will be the generally accepted accounting principle formats and components of the balance sheet and the income statement, and we will use the Morning Joe financial statements that are in the appendix at the end of Chapter 15 for that. Number two, we'll focus on the investments in stock known as equity investments. One corporation is able to invest in the stock of another corporation, just like you and I and other individuals can, but intent is very important. When intent changes, so does the accounting. What we hope to do today is to link intent to the type of accounting that is done for the type of stock or equity investment. And the third thing that we'd like to do is to introduce you to the concept of fair value accounting or mark-to-market accounting and what it causes, unrealized income, that's reported in a new section of the balance sheet called accumulated other comprehensive income. We'll talk about that in a little bit. Item or two before we start the broadcast, I think it might be worthwhile to stop this video and download the class notes from your class notes folder on Google Drive and have those in front of you so that take some notes. Also, the second thing to bring up on your screen would be from Chapter 15 class notes, the Excel spreadsheet templates, exercise 1522. We will review that spreadsheet to give you a good start on how to use Excel and this concept of fair value accounting. So go ahead and stop the video, download the course out or the chapter outline, and bring up on your screen exercise 1522. Okay, here is the outline for Chapter 15, and you see there are 5 objectives. Number one, why do companies invest in debt and equity securities? As the e-lecture indicated, sometimes a company just has some extra cash and it wants to earn some additional income. Just like when you have a summer job, you don't spend all the money that you earn, hopefully. You put some of it away in a savings account so that you have that money later on, plus a little bit of interest. Companies are exactly the same way. Excuse me. Learning objective 2, describe and illustrate the accounting for debt instruments. Very quickly, if you would review the e-lecture and the related animated examples, what you will see is that the investor represents the lender to the borrower that we had in Chapter 14. Where the borrower from Chapter 14 owed the money and showed that liability on its balance sheet, in Chapter 15, we are taking the perspective of an investor that will show the loan as an asset and will have a long-term receivable. Instead of having interest expense, if you are the borrower, the investor will have interest income. So what you should see from learning objective 2 is that there is a parallel between the borrower, Chapter 14, issuer of bonds or notes, and the investor, the buyer or lender of cash for investments in loans. Learning objective 3, now this is where we want to spend a little bit of time accounting for equity investments or when one corporation buys the investments of another corporation. In addition, relating to that, we'll talk about valuing these investments, marking them to market, and realizing or recording unrealized income. Also, in the financial analysis and interpretation, the dividend yield is a way to compare the return on stock to the return on, let's say, a debt instrument. The e-lecture will take care of that particular topic. If there's something that we do not cover in this particular Hangout, please review the related e-lectures, and if there are any questions, please do not hesitate to email those questions, and I will address them in an upcoming Hangout. Okay, looking at the outline, you can see the very familiar schematic of a long-term note. The point of this being here is that the investor will have a parallel type of progression to the borrower. And instead of paying interest expense, if you're the borrower, the lender receives that cash as interest income. Okay, let's turn our attention to the equity investments. When one corporation buys another corporation. As I had mentioned in the introduction, intent causes different ways to account for this equity investment. Okay, before we go any further though, let's make sure that we can place these items on the income statement and the balance sheet. So this is the Morning Joe financial statement, specifically the balance sheet from the appendix of the chapter. And what I'd like you folks to try to do as you work through these exercises is to think where the long-term investments should show up in the financial statements and how the different journal entries that we make in this chapter cause increases and decreases to the balance sheet. So, reviewing the format of the balance sheet, you can see first you have the current assets. They represent those assets that will turn themselves quickly into cash. Quickly meaning in the next year. And so you can see the order of these assets would be the order of liquidity. Liquidity represents how quickly these assets turn themselves into cash. Those that are further up on the balance sheet turn themselves quicker into cash. Those that are further down the balance sheet in the current asset section take longer to turn themselves into cash. The item that we'll be investigating in this chapter would be the trading investments. These trading investments represent short-term investments that companies will buy so that they can quickly sell or do the deal that they are looking at. Also, we'll talk about this valuation allowance. We had mentioned the mark-to-market convention. That's where the valuation allowance enters into things. Also, there is a second section here under the long-term assets labeled investments, and this is where companies that invest long-term, not for the purpose of just having idle cash, but the purpose of influencing the operations of the target company, will put those particular investments. Let's say that you are a company like General Motors and you want to make sure that you have suppliers that will always supply you instead of Ford and Chrysler. So you actually buy, let's say, the company that makes the seatbelt harnesses, or you buy the company that might make the grill work for your particular car. The third item on this particular financial statement that we would want to focus on in this chapter is the owner's equity. And the shareholder's equity really is comprised of three major parts and then one subpart. The first part would be the contributed capital. That would be the preferred stock, the common stock, and any additional paid-in capital over the par value of those shares that investors pay above the par value. That's called contributed capital because investors contribute their cash to the corporation with no other expectation than receiving a return. They don't receive any employee compensation. They don't receive any goods or services. They just contribute their money to the corporation for the corporation to invest and give them a return later on. The second part that you have in owner's equity is known as retained earnings. That is the earned capital. Retained earnings represents all the income earned in the past, less all distributions to owners in the form of dividends. The third portion that you have, and this is something to add to the shareholders' equity section on this page, that is called AOCI. I will put that in quotes. That's my abbreviation, and it represents accumulated other comprehensive income. Accumulated other comprehensive income is a fancy term for income that is what accountants call unrealized. Unrealized means that the particular investment in stock that the company has bought has either appreciated or depreciated in value, but the company hasn't realized that gain or loss because they haven't sold the stock yet. What the accumulated other comprehensive income does is monitor the increase or decrease in value of the investments that you might see in the short-term section, trading investments, or in the long-term section, investments. Okay, so that is the areas of the balance sheet that we'll be looking at in this particular chapter. Also, in the chapter, there is some income statement effects that we want to recognize. And here is the income statement for Morning Joe, and you can see it is fairly comprehensive, but let's just review some of the format items that you have in the income statement. And we'll have 5 basic areas that the generally accepted accounting principle format will show. The first item that you have, or the first area that business people will look at, is the spread or difference between sales and gross profit. Now, there isn't anything gross about profit. That just means that this represents the income that the corporation has made after it considers the cost of the merchandise that it has sold to customers. A high gross profit means that the company has a strong brand image and is able to mark up selling prices over its cost to buy those goods. For example, Coca-Cola will have a higher gross profit or a higher markup than Sam's Choice Cola. Why? Well, Coca-Cola has the brand image that allows it to do that. Similarly, BMW cars will have a higher markup or gross profit than Hyundai, for example. Second section that you have on the income statement represents the operating expenses. Those are the selling expenses necessary to move the product into the customer's hands, and the administrative expenses, which represents the cost of maintaining the organization of the business. What you should be able to do is to recognize that these operating expenses represent the cost of operating plant, property, and equipment. Let me say that again. The operating expenses on the income statement represent the cost to operate plant, property, and equipment. After deducting the operating expenses, that gives you a caption called Income from Operations, or we have given this the nickname of EBIT in a prior Hangout. EBIT represents earnings before interest and taxes. The third item that you have would be the interest revenue, interest expense, and any gains or losses from the sale of assets. So here's what the income statement does. It separates the cost of running the assets, which are shown in the operating expenses, from the cost of financing the assets. Remember from our previous Hangout, we said that the long-term liabilities are used as financing sources for plant, property, and equipment. So the income statement shows the cost of running the assets in its operating expense section, and it shows the cost of financing the assets, borrowing money, in the non-core or other income and expense category. After deducting the interest expenses and any gains or losses, you have the caption Income Before Taxes. That's what the company earns before Uncle Sam gets involved. And because the government takes such a big chunk out of corporate profits, the statutory rate in the United States is 35%, that caption is shown separately. After deducting the taxes, you have net income as the amount that's available for distribution to the owners. Now, I did say that there are 5 items on the income statement, and if you've been counting, we have only considered 4. So what is the 5th one? Let's add that to your notes. That 5th item would be non-recurring items. These are special items. They are usually infrequent. They are not part of normal operations. And because of that, investors would want to know and identify them as temporary and not ongoing. For example, a few years ago, General Motors went through a restructuring because of the economic downturn. As a result, it sold its Hummer division. It discontinued the Pontiac and Oldsmobile divisions, and these were catastrophic one-time events. Because of the expenses of these big one-time events are so significant, and they should be advertised to the investors, they would have been reported in this section called non-recurring items. So to review, the 5 areas of the income statement are the gross profit, which gives investors an idea of the company's brand image. The operating income, which considers the income after the cost of running the assets. The third area would be the cost of financing the assets, the cost of debt. The 4th item would be the amount that Uncle Sam takes from the company. And the 5th item would be this special non-recurring item that's reported separately. Okay, all right, so that was a little bit of a side route to give you perspective on where to spot the different journal entries that we will be making here shortly. Okay, so let's go back to item 15.3, which talks about ownership of stock. The accounting folks have said, okay, in general, there are 3 ways that companies should account for their stock. If a company buys shares of stock in another company and buys less than 20% of that company's stock, it's really interested in just a casual investment, a place to park cash so that it can get some extra dividend income. It's not interested in control. It's not interested in influencing the marketing aspect of the company. It just wants some idle cash. And so the general assumption is when a company buys stock in another company and it buys less than 20%, that investor does not desire control, and it uses something called the cost method for this investment. That means that the investment is recorded at its cost. That you probably have heard about when we talked about investments in Accounting 1. That come up in Chapter 15 are ownership between 20 and 50%, and when ownership is more than 50%. Now, when an investor company buys a target company and buys more than 20% of the shares, there's probably more intent than just having some idle cash. What that investor company wants to do is to influence the management, the products, and the customers of the target company. Remember the example that I mentioned about General Motors wanting to control its suppliers to make certain critical suppliers don't sell to Ford or don't sell to Chrysler. So they want to have a member on the board of directors, they want to share some management personnel, and they want to influence the decision-making of that target company. Because of that, the way the parent or investor company recognizes income differs from the cost method. And we will demonstrate that through some of the exercises that you have. Finally, when the parent company, the investor, buys more than 50% of the outstanding shares of the target company, well, that parent company, pardon me, has complete control. If you own 50% of the shares of the company, you have majority vote, and so your opinion goes. In cases like that, there is complete control over the target company, and literally the financial statements of the two companies are added together and reported as a single entity. They are no longer considered parent and subsidiary. They are considered a consolidation where there is one income statement and one balance sheet for the two entities. Pardon me. For the equity investments section, review the e-lectures and the animated examples and the related practice exercises to see how the accounting goes for each one of these three categories. And be sure as you do those exercises that you note what is the ownership for the problem that you're dealing with. And here's a heads up. In this particular chapter, only the 20% ownership for cost method and the between 20 and 50% ownership for the equity method are illustrated in the examples. More than 50% ownership where there's complete control and consolidation of financial statements is a topic for advanced accounting that accounting concentrators don't get until their senior year. Okay, let's take a look at topic 15.4. Pardon me, folks. I still get choked up when I talk about this stuff. What we're talking about in topic 15.4 are something called trading securities, available for sale securities, and held to maturity securities. Trading securities would be done by, let's say, brokers. They're in the business to make a quick buck by buying low today and selling higher in 2 or 3 days. That's their business. They are speculators, and their intent is to buy low, sell high quickly to make a capital appreciation gain. Those companies will report their stock investments as a current asset because they intend to sell them within the current year in the current assets section right underneath cash. The reason why they're right underneath cash is that they could buy the shares in the morning and literally sell them in the afternoon to get cash. So these are very liquid investments and are reported almost like cash. Pardon me. The second classification of securities are known as available for sale securities. This happens in the case where a company wants to buy equity securities so that it can get some dividend income, but when the time is right and the opportunities are such that they need cash, they will make these securities available for sale. Their intent is not to control the target company. They do want to make some money, but they are not in the business for short-term speculation. So oftentimes, excuse me, these available for sale securities are a little bit longer in their holding period. So often they might be shown as longer term investments. Excuse me. And finally, we have the held to maturity securities. Held to maturity securities are bonds where a company who's the investor buys the bonds of the borrower and intends to hold those bonds until they come due 10, 15, 30 years from today. They are definitely shown as a long-term investment because of the long-term holding period that debt securities or held to maturity securities entail. Okay, now, how does all this relate to fair value accounting? Okay, here it is. Let's suppose that you invest in your favorite company, whether it be Facebook or Twitter or Apple Computer. Your hope when you buy it today is that you can buy it at a fair price, and then months, years down the road, you can sell it at a higher price. The way that you get money out of your stock investment is by selling it. Now, it may go up in value between the time you buy it and the time you sell it, but that doesn't get you any cash. All you have is promised appreciation. What the financial statements are beginning to show in the trading security section and in the long-term investment section is this price appreciation. So at the end of every year, the company is going to show whether its stock investments have gone up in value or have gone down in value. That's what fair value or mark-to-market accounting represents. How that relates to the financial statements is that unrealized income is shown in a new caption of the income statement called Other Comprehensive Income. You can label that item unrealized to represent an appreciation or depreciation in value that has not been realized in cash. You can't spend something that's increased in value without selling it. Additionally, there is a new section in the shareholders' equity part of the balance sheet known as accumulated other comprehensive income. So here's the analogy. As a company earns net income, it increases its retained earnings, or the company increases its earned capital. So net income is to retain earnings, as unrealized other comprehensive income is to this area, pardon me, AOCI, accumulated other comprehensive income. So what the balance sheet does is essentially recognize the component of potential shareholders' wealth that has yet to be realized by selling the securities. Okay? All right, that's the brief review of this particular chapter. What I'm trying to emphasize is how the financial statements report these various investments. And admittedly, I have not reviewed in detail all of the learning objectives in this Hangout, but I've emphasized the items that I think are most important. Now, let's take a couple of minutes to review one of the exercises at the end excuse me, of the chapter, exercise 1522. So it may be worthwhile for you to stop this Hangout and, pardon me, and download from your G drives under class notes exercise 1522, and I am going to share my screen with that. Okay, you should see on your screens right now the template for exercise 1522. Pardon me while the Excel downloads this from my drive. Okay, there it is on your screens. I do apologize for the delay. In exercise 1522, it's addressing how we can record equity investments and then mark them to market to show their fair value. So here is the setup. What you see on the blue side of the screen is the problem that is at the end of the chapter 15, and also this is the same problem that you will see in Cengage. Now, you have a company called Storm Inc., who is the investor or the buyer of stock securities in various target companies. The target companies would be the Dust Devil Company Inc., Gale Inc., and Whirlwind Company. Now, these investments were made during the year 2014, and the Storm investor bought 1,900 shares of Dust Devil Company for $81,700. It bought 850 shares of the Gale Company for a total cost of $68,000, and it bought 2,850 shares of the Whirlwind Company for a total cost of $114,000. So during 2014, the Storm Company bought a total of 3 investments that cost it $263,700. Now, Storm Company has to prepare its financial statements at the end of December, specifically December 31st, 2014. What the accounting rules dictate is that it must mark to the market the fair value of each of these securities. So what the Storm Company did was to go to finance.google.com or finance.yahoo or one of the other companies or one of the other information providers and looked up the selling price of the shares on December 31st, 2014. The company found that the Dust Devil Company was worth $40 a share, the Gale Company was worth $75 a share, and the Whirlwind Company was worth $42 a share. Now, what the exercise is asking us to do is to provide the journal entry to adjust this available for sale security to its fair value at December 31, 2014. So what we need to do is to compare the total cost that Storm paid for these securities to what they are worth at December 31st, 2014, and the difference between cost and fair value would be this unrealized gain or unrealized loss that will be reported in other comprehensive income. Okay, so let's turn our attention to this particular spreadsheet. First, let's just enter in the cost of the individual securities. So the cost information will come from the first schedule labeled cost. So the, pardon me, Dust Devil Company had a cost of $81,700. Pardon me. The Gale Company cost $68,000, and the Whirlwind Company had a cost of $114,000. Now, a secondary thing that I'm trying to do with this particular handout or Hangout is to show you how to use Excel formulas and functions to really use the power of Excel, how to add, how to multiply using Excel. Now, what we would want to do is to sum or add these 3 items. To start a function or a formula in Excel, merely push the equal sign. And when the equal sign appears in a particular cell, that notifies Excel that a formula or a function is coming. If you would go to the top left-hand side of the input panel, you see this, excuse me, FX, which is a mathematical symbol for function. And if you would click on it, a pop-up menu appears for the various functions that are commonly used with Excel, and oftentimes they have names that look very familiar. And as we scroll down the pop-up window, you can see one labeled sum, pardon me, that indicates, well, we want to add certain values. Alternatively, what we could do is just to type the word sum, and automatically Excel would accept that value. In the next pop-up menu, it makes a suggestion, geez, let's add the values in J or cell J20 through J23. I'm sorry, J22, and put the answer in cell J23. Well, that's exactly what we want to do, and as you can see, the answer is 263,700, which matches what we had in the original problem statement. Since we like that, let's click OK, and you'll see the result. Okay, now, what we have to do next is to determine the fair value of the shares. How do we do that? Well, we'll take the number of shares of each of the three companies and multiply those shares by the respective cost or fair value per share. For the Gale company, the Storm company bought 1,900 shares. Or sorry, for the Dust Devil company, 1,900 shares. For the Gale company, 850 shares. And for the Whirlwind company, 2,850 shares. And from the second table, you can see that the Dust Devil company had a fair value of $40 per share. The Gale company had a fair value of $75 per share, and a value of $42 per share. Now, what we want to do is to multiply the number of shares by the market value per share to get a total fair value on December 31st, 2014. So let's enter Excel formulas that do that. Remember how to start a formula? Push the equal sign. Then all we need to do is to push and point and click on the values that we want to incorporate into the formula. So we want to take the value 1900, which you see in cell N20, and multiply it by the value that's in O20. To signify multiplication in Excel, push the asterisk key, which is above the 8 on the keyboard, or if you have a number keypad, it's at the top of the number keypad. And then move to the cell where the 40 appears, which you can see is in O20. And this formula says to Excel, take the number that's in N20, the 1900, multiply it by the number that is in cell O20, and put the result in cell L20. To have Excel execute the formula, push the Enter key. And there you have it. If you would multiply 1900 by 40, verifying that with your calculators, you can see that $76,000 is the amount that we intend. Okay, now let's do that for the next one. Start a formula with an equal sign, point and click to the first value, 850, in cell N21, indicate multiply by pushing the asterisk key, and then moving to the cell that contains the number 75, O21. Pardon me. To execute the formula, push Enter. And you can see the cost or the fair value is $63,750. We could do that for every item that's in a column, and we would get the right answers. But, gee, that can get a little bit tedious. What we can do is to execute an automatic copy from cell to cell. Here's how you would do that. Move your cursor to the cell where you want to copy from, and you'll notice in the bottom right-hand side of the cursor, there is a little square. That is the auto copy symbol, and when you move the cursor to that auto copy symbol, it changes its shape from the open wide white plus to a closed black copy plus, like that. Click and hold the left mouse button and drag to the formulas or drag to the cells that you want to copy to. When you release the left mouse button, Excel will automatically copy the formula from the original cell to the target cell and enter the product. And there you have it. And examining that cell, if I just click on the cell and then look at the formula bar, you can see I'm taking the value in N22, which is the 2850, times the value that is in O22, which is the 42, and entering it in cell L22. Now, I want to add this particular column, and you remember that the equal sum is the Excel function that accomplishes that. Merely entering equal and typing the word sum with a left parentheses will start the function. From here, go to the first cell in the column that you want to add, continue to hold the left mouse button, and drag down the remaining column to encompass the cells that you want to include in the total. Type in the right parentheses to close the summation, and then push enter to execute the sum. So what we've discovered is that the fair value of these three investments at December 31, 2014, total $259,450. Whoops, that's not good news, because the fair value at the end of the year is less than the cost to buy these securities during the year. That means that the company has lost money, and we should recognize that as an unrealized loss in other comprehensive income. So let's go to cell J25, pardon me, and enter a formula for that. What we want to do is to take the value in the cost column and deduct it from the fair value, or deduct the fair value to get the gain or loss. So push the equal sign, click on the fair value, excuse me, the fair value at December 31st, 2014, and subtract from it the cost, which is in cell J23. Pushing the enter key will give us the result. And you can see the value is in parentheses, and that means that the storm company has lost $4,250. Pardon me. Okay, now we have all the information we need to make a journal entry. So let's go up to the journal entry and do that. What we need to do is to recognize this decrease in fair value as an unrealized loss that will be reported as an unrealized loss excuse me, on available for sale investments. And the amount, let's enter an equal sign. Well, just enter in $4,250. Pushing the enter key will insert the value. And we want to report that as a decrease in accumulated other comprehensive income and reduce the value of the asset. So this account valuation allowance is a little bit like accumulated depreciation in that it reduces the value of the asset account. Okay, so by crediting the valuation allowance, we have taken the 263,000 and reduced it to 259,450. Okay? Okay, all right. So that is how you would use Excel and Excel formulas and functions to calculate the value for this particular journal entry. All right, in addition, there is an essay that asks us to evaluate what has gone on, and what I would like you to do is to type in the particular answer that you think is appropriate for that. And if you have any questions, please send me an email. Here's one other item that I would like you guys to be able to do, and that is to recognize how journal entries affect the financial statements. And here's what this little spreadsheet does. It shows the categories of the balance sheet: assets, liabilities, and then the three components of owner's equity: contributed capital, which is the stock; earned capital, which is retained earnings; and then the new caption from Chapter 15, this unrealized capital, accumulated other comprehensive income. Also, what we have is the income statement: revenue, expense, and net income. And then we have the cash flow statement, which is the topic of Chapter 16, to show the increase or decrease in cash and categorize it as whether that cash came from operating sources, running the business that you're supposed to run; investing activities, buying or selling long-term fixed assets; or financing activities, borrowing money or paying off debts. Okay, so let's analyze these items. Okay, the debit to the unrealized loss represents the equivalent of an expense. And so a debit to an expense increases the expense. So let's enter 4250 under expenses. Credit to the valuation allowance. Remember, the valuation allowance is a little bit like the allowance for accumulated depreciation is to plant, property, and equipment, and it's like the allowance for bad debts to accounts receivable. The valuation allowance decreases the asset account investments. So the credit to the valuation account will decrease assets, so we will enter in a minus 4250. Okay, so the direct effects of this journal entry: reduce assets and increase expenses. Oops, we can't be done because we know that assets must equal liabilities plus owner's equity. That's the balance sheet equation, and that's not happening here. So there must be some secondary effects that we need to account for. Well, here they are. We did not affect revenue, so we can put a 0 in the revenue. And so if there's no change in revenue, but we increased expenses, 0 minus 4250 means that the company lost $4,250. Now, how do you want to classify that loss of income? Well, it is not yet realized, and so we would categorize it in the third unrealized capital portion of the balance sheet. So let's show the decrease in income to be equal to the decrease in unrealized capital. Now let's examine the balance sheet. We see that assets now equal the sum of the change liabilities plus 0 change in contributed capital plus 0 change in earned capital plus a negative 4250 change in unrealized capital. Okay, now what about cash flow? Well, cash flow only changes when a company receives or spends cash. In this case, because there is no debit increase or credit decrease to the cash account in this journal entry, there will be 0 effect on cash flow. Okay, that's the end of this particular Google Hangout. Please give the exercises at the end of Chapter 15 a shot. They will be due on June 30th, and on Monday, June 28th, we will begin to discuss the cash flow statement. Have a good day, and join me later for the Hangout for Chapter 16. Thank you.